Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
Hello, everybody, and welcome today. I'm joined once again by Jody, and we are going to expand upon a topic that we touched on several weeks ago, cash flow. So we talked about the cash metric and the cash KPI of wanting somewhere between 10 to 30% of your revenue in the bank at all times. But we didn't talk a ton about ways to do it and how often should you look at your cash. And so that's what we're going to talk about a little bit more today. So let's start with you, Jody. So how often should I be looking at my bank balance?
Great question. I look at mine pretty much every week. Some people look at it daily. Some people look at it monthly. It really depends on your cash situation. But I would say weekly is probably not a bad time. And look at it every single week at the same time, every Monday at the same time. So you've got an idea on the ebbs and flows of your business on how much cash you should have. It's kind of funny with cash flow. That was one of the first services actually we offered as a virtual CFO service when we started back in 2002. It was one of those things that I picked up at actually, it wasn't even an accounting firm. It was working for a manufacturing company, a $250 million manufacturing company. We did cash flow. We did a daily cash flow. And with that, it was one of those things that I thought, wow, this is great. You know, it tracks how much money is coming in, kind of like the inflows, and then all the outflows. And it wasn't like a financial statement like you'll see like a lot of accounts will prepare. It was truly cash coming in. We didn't care if it was a loan. We didn't care if it was, a bill, anything like that. It was money going in and money going out. And that was key, and kind of tracking that as the week or month goes by. And so it's kind of funny. We brought that and introduced that to a lot of our small business clients when we first took over. And it was like, voila, the light popped on. It's like, wow, I don't know why we just didn't think of this and do this, from day one. We did it on Excel. It was really simple. And it really brought a lot of attention to everything. It was like one of those things that people could really see on the short term. And I say short term, 6 to 8 weeks. They could really get a good visual or good perspective on the next 6 to 8 weeks and see how things are going. And so it was kind of funny that it was one of the first things that we started, introduced in the CFO service way back when. And it's probably, I would say, one that the majority of our clients have, even if they have an accounting firm or accountant, or, they do other things. We typically have a cash flow meeting with them as well. I'd say real close to probably 60% of all of our clients definitely take us up on this offer.
And I think that to Jody's point, one of the keys at Summit, and one of the keys of this podcast is we want small businesses and we want our customers, our clients, doing the same things that big businesses are doing. And to Jody's point, I worked for a couple of large organizations, and they were doing this. They were doing this every day, every week. And the main reason they were doing it is because they had a lot of cash in the bank. So they wanted to know how much they could transfer to higher interest accounts. So again, that's one reason to do it. But also, as times got a little bit more difficult, it was important to know, okay, what is the next month going to look like? Are we going to be able to make payroll? How does my forecasting change based on what my cash flow looks like? So this is really important. And I can promise you, every business that you know out there, all the big names are doing this exact same thing. They're looking at their cash, they're looking at what their outflows are coming in. It's not that complicated to do. So Jody touched on it a little bit, but you know what your inflows are. You can look at your balance sheet, you can look at your accounts receivable, and you can say, okay, I know who's paying me, I know when they're going to pay me. I have an idea. Maybe someone's going to pay me 3 days later than I thought, but you can at least get an idea of when they're going to pay me. So that's the starting point, is those inflows. And we recently had a podcast about recurring revenue. And if you have recurring revenue, you can also build that into the top part of the forecast. You can say, okay, I know my receivables look like this. I know every Monday I collect $200,000 of revenue from my recurring ones. And that's really the starting point of building a cash forecast, is those inflows. Any inflows I'm missing there, Jody?
Yeah, no, I would say, even before inflows, you got to start with your beginning cash balance. And that's the cash balance that's on your check register, not what the bank's saying. So you want to make sure that you have your beginning, check register balance up there. And then you got the inflows. And I would say with the inflows, there's a couple ways to look at that too, is that it's really any cash coming in. So it's like if you as an owner are going to put cash in the business, it goes up there under the inflows. It's not revenue. We're not looking at paying taxes on it or anything like that. It's just simply money coming in. And so you list them all up. And some people will list their accounts receivables. Like if you have hundreds and hundreds of AR accounts receivable balances out there, then you're not going to want to probably list every single one of them row by row. Maybe group them together, maybe group them in departments, or group them to where you've got an idea, something that you can actually make actionable decisions on. Or if you just have a few, like let's say maybe you've got 10 or 15 enterprise clients you're constantly working with, and they come from the same source, well, list them all out separately. And so hey, when is XYZ Corporation going to pay us? They're going to pay us next Tuesday or 2 Tuesdays from now. And I would do this all the way through at least 8 weeks, 6 to 8 weeks for sure. Just map it all out. Doesn't necessarily mean they're going to hit on those exact same days, and they probably won't, but it gives you an idea on what to expect, when to expect that money to come in. Because the biggest thing again here is we're building this cash flow for expectations. Whether Jamie said your expectations are going to be actually investing the money at the end of the week, end of the month, or maybe the expectations are, do I need to borrow my line of credit? When do I need that to happen? Or when do I need to take distributions out for profit distributions out of the company to put down a really nice condo in the Cayman Islands or something like that? So it depends on what your situation is. You need to really have that good understanding, because the worst situation would be is taking that money out for that condo in the Cayman Islands and finding out that, oops, we're going to be in a big world of hurt here in 3 weeks because we got this bill that's coming up that we forgot all about. That's what we want to try to avoid with this, is so you have a clear expectation of what cash looks over the next short-term period. We're not looking over a period of months. We're looking over a period of weeks, and that's the key to that. So go ahead, Jamie, on the
Yeah, I was going to say, one more thought on the inflows is a lot of times the numbers are the starting point, right? So if I know what the numbers look like, the important part is the conversations. And this is an accountant talking here. Like, I love the numbers, but what's important to me is what comes out of those numbers. So if I see that customer X keeps paying me 15 days late, I can have that conversation with that project manager and be like, hey, why does your client keep paying us 15 days late? Maybe you should talk to them about, paying us a little quicker, or have a conversation with them. Or if it's a really tight month, say, hey, we just need them to pay quicker this month because there's a lot of reasons that'll help us. And so I think it's those conversations that come out of it that are super important. And we don't want to miss that part of it. Like, pulling together a cash flow and knowing what cash looks like is just the starting point. So, oh, okay, cool. We know cash is going to be here in 6 days, but the question is, what can I do about it? And a lot of times those are the conversations that are going to come out of it that are super important.
Oh, for sure. I mean, and it could be just as simple as being aware, right? And so it could be like, hey, I've got a payment coming in from XYZ company coming in Friday. Oh, we typically have to give them a quick call before that, 3 days in advance to make sure we get it timely. Or we want to make sure that we follow up. Or maybe that one's not going to get paid at that point because we're holding something up. And so it's important to know that too. So it's just simply really being aware of the situation, that everybody's on the same page, from the owner to the AP to the AR clerk, or maybe that's the same person, who knows, all the way to the person that's ahead of the job. It could be that, hey, XYZ is holding their payment. Why? We need to figure it out because we're going to need cash here fairly soon. Or, it could be a lot of different reasons, but I think the awareness is the big thing there.
So again, we've gone through the inflows, and the next section obviously is the outflows. So outflows, there is the predictable part, which is the AP. So you know what your outstanding AP is, the due dates on that, so you can kind of flow that through. So that's the first element of the outflows. But then the second element is what are those recurring payments that you're making? How much do you pay in rent each month that is going to go out on the 15th, or on utilities? We know we pay about $300 on utilities every month. Let's forecast that out for the next 2 months, so that way I can look 8 weeks out. And so that's kind of the two main elements of the outflows. Any additional ones I'm missing there, Jody?
Yeah, I would say similar to the inflows, you can group them whatever makes the most sense. Like, for instance, if you've got a ton of AP, maybe you just list it AP, or maybe you break into categories again. Or if you don't have as much, maybe you break every single bill out separately. And it may be you have every bill broken out separately from one vendor. It could be you're paying XYZ company X amount of dollars. There's 5 bills to be paid. Maybe you break them all 5 out. If you're going to pay one at one time, one at another time, just so that makes easy and simple for you to look at a glance and know, hey, here's what's going out as an outflow. Here are the loans that are going to get paid out as an outflow. Here's the rent, like Jamie was saying, it's going to get paid out once a month on an outflow. Here is our distribution for taxes. When is that going to come out to cover your quarterly estimated payments? Or if you're putting it aside into a tax reserve account monthly, or weekly, depending upon your situation, or if you're planning on, maybe having a team retreat in 6 months, you have to set some money aside. That's an outflow. It's coming out of your checking account. Maybe it's going into a savings account. building some cash. So again, it's not necessarily money leaving the company. It can be money going from one account to another, but it's coming in or going out of your operating account. So at the end of the day, that operating account has to balance to what's in your actual check register. Extremely, extremely important. And that check register has to reconcile to the bank account. We can't be missing anything that could throw us off there. So it's important to have your bank, reconciled as often as you're looking at this cash flow. Hopefully it's weekly. Some do it every other week. Some even risk it and do it monthly. That's kind of rolling the dice, in my opinion, a little bit, even if you're a real healthy client or a real healthy bank flow, just for the obvious reasons we point out. But definitely on a weekly basis, have your account reconciled. And some of our clients, and we do it as well, reconcile daily. Why not? With technology nowadays, shouldn't be that difficult to do. And then you can have your cash flow, reconciled and up to date daily.
One of the big reasons to do it frequently, especially in this industry, our biggest cost, and especially for any service-based industry, it's people. And payroll is pretty predictable, but it's also a big chunk of money. It's anywhere from 50 to 70% of the cash you pay each year is going to go to payroll. And so if that's basically 2 days a month, you're paying 50 to 70% of your monthly costs. And so it's really important to know prior to that happening how much you're going to pay and how are you going to do it? Do you have enough money to do it? Do you have to transfer money from your savings to do it? Do you have to draw on your line of credit? And so it's really important to do that. And if you're doing that 2 days before the payroll happens, you might not have enough time. So you need to do it every week at least, to Jody's point, because you want to make sure you have enough time to react and to be quick on that and do those things you need to do in order to get that extra cash in case you might have a close payroll call.
Yeah, the worst thing you don't want to do is you don't want to be on vacation and get a call from your accounts payable clerk or your office manager or your accountant if you're outsourcing it, letting them and saying, "Hey, I'm glad you're having a great time on vacation. By the way, we're going to need $30,000 tomorrow to cover your payroll." You don't want that situation to happen, right? I mean, it's possible that if you'd have known that a week in advance or 2 weeks in advance, not a big deal, right? You plan for it, you get it taken care of. But you may not have that money sitting in something where you can actually transfer it the very next day because, oops, we didn't look out, we didn't look forward. We didn't look at our cash flow position. It's happened before. I'm sure it's probably happened to a lot of people here where it kind of caught you off guard. And the key here is not to let that happen. It's to make sure this is very predictable, like what Jamie was saying. Everything's predictable. Payroll is the big thing. The last thing you want to do is let your employees know, "Hey guys, sorry, I made a mistake," or "Hey everyone, I made a mistake, and you know what? We're going to push your payroll off a couple days because I forgot to look at or I didn't take the time to look at the cash position." We're not in a bad situation because 9 times out of 10 you're not. It's just simply a timing issue, right? And so and you don't want your team thinking that it's not a timing issue, that it is a bad situation. Or, there's a lot of different things that by looking at this, it'll save a lot of issues for sure.
And I think to Jody's point, you could be a very healthy company and you could have bad cash days. Like for example, if your payroll is $100,000 twice a month and your largest customer pays you $100,000 a month, if they're 3 days late on giving you that check, you could be a pretty healthy company with quite a bit of money in the bank. And that could put you at ends like, oh man, how am I going to make payroll? Because I'm missing that $100,000 check that's supposed to come in 2 days ago. And now it's a day late. And now I'm having trouble making payroll tomorrow. So it doesn't matter. I mean, again, you could be a super healthy company. And sometimes you just have those days where it's just like, oh man, our cash is just in a tough situation this week.
Yeah. And I would say to kind of add to that, having a really solid line of credit is important, and to use it as a true line of credit so that, and some people tie it right to their cash, right to their operating account, so that if your operating account goes negative, it draws on line of credit. That's huge. If you can have that set up and get that set up so it's actually utilized as a line of credit, not a loan, but a line of credit where it's paid back right away, that could help out a lot in the event that something like that does happen. And so I'd highly recommend doing that. If you don't have one, get one for about 10% of your annualized revenue if you can. That's what you're shooting for. Most banks are going to push back, especially if it's the first time you ever had a line of credit. But then as you mature in your business, you should be able to get it closer and closer to that dollar amount. And then, lock it in for 2 years. Lock it in so that you've got it. It doesn't need renewed in 2 years as opposed to annually, which a lot of banks will do annually. And so that's key too. So if you can get locked in every 2 years, make sure you understand the regulations or what their covenants are on the line of credit, if it needs to be paid down for a certain period of time, or if it needs to be paid off for a certain period of time, or if it just goes up and down with with cash. But you make sure that you know that so you don't violate any of those covenants on the line, but make sure that's available for you there in the event that, mistake does happen. You didn't look at the cash flow, you're on that retreat, and it's a lot, or on the vacation, like I mentioned, it's a lot easier calling the bank up and saying, hey, can you cover me on this line of credit, with my line of credit for, or whatever. It's just an automatic thing. The line of credit's there and it covers it. Or if it's not automatic, you can call and move some money over. But hugely important.
Can you expand on that just for 1 sec, Jody? I know you talked about using your line of credit as a line of credit. What if you don't use your line of credit as a line of credit? What if you use it as a loan? What are the consequences that can happen if you do that?
Yeah. So what happens there is what the bank wants to see is they want to see it moving up and down. They don't want to see it flat. If they see it flat line, they know that you use it as debt as opposed to what it was supposed to be used for. And so what a bank will do, and it's not may do, it's a bank will do over a period of 1 or 2 years, depending upon how long they've seen it flatline or not move a whole lot. They'll go ahead and term it out. And so they'll go ahead and put a term on it and they'll term it out over a period of X amount of years, maybe 5 years, 6 years, or whatever. That in itself could put a big crimp on the business. If the business isn't ready for a payment of X amount of dollars, that could take a real negative impact or negative effect on the company. So the bank will turn the loan out. Typically, you're not going to get a whole lot of say on how long it gets termed out or what interest rates you're going to get. They'll just do it. And so that's why it's so important to utilize the line of credit as a true line of credit. It's there to cover short cash flow, a payment getting made late, that type of thing. It's to cover that balance so that it doesn't negatively impact your cash position.
Yeah. And real quick, take a little break here to plug our email address. So we're always looking to improve the show. So if you have any topics for us, if you want to join the show as a guest to kind of talk about that topic, or if you just want us to touch on this topic, please email us at vcfo@summitcpa.net. Again, vcfo@summitcpa.net. So yeah, we're always looking forward to emails and messages and topics and questions that we can cover on the show. So please reach out to us if you have any. So Jody, we talked about kind of what a cash flow worksheet should look like. We talked about the beginning cash balance. We talked about adding the inflows, subtracting the outflows, and then obviously that kind of gives us a daily cash total. So what are some tips we can give in order to improve our cash flow if it's not looking good or it's not looking like we want it to?
Well, obviously, we mentioned we've got to come up with different means of money. So recurring revenue we talked about in the past, that's hugely important. If you can come up with recurring revenue, that should kill a lot of cash woes. It really helps your business out tremendously. The more predictability of your clients. So like if you're getting a contract that you're supposed to get paid 15 days after the invoice is sent out, make sure your invoice is sent out timely or even early so that you get in the queue to get paid off. Some companies pay every other week. Some companies pay on the 25th of the month. If you get your invoice to them on the 26th, well, guess what? No matter what your contract says, you're not going to get paid for 30 more days on top of that 15 days because they'll start making those payments then. So it's really important to stay on the accounts receivable and making sure that you do your due diligence there. Get your invoices out timely. If you need to make a preemptive call, especially on the very first invoice that you send out to a client, maybe a new client, a preemptive call letting them know, hey, we're sending the invoice out. Want to make sure I got the right address. Want to make sure it's going to the right person, and just kind of as a friendly call to help them out. You'll find that may go a long way with the client, for sure, because you're talking to again somebody you're not normally talking to. It's in their accounting department, and you're getting things set up on the right note. Because one thing you don't want to do is you don't want to wait and 30 days after it's due, it's still not due. So you still don't call them because you're worried about losing the account. So then 45 days comes up and you're like, well, we really need this money here. We're running low on cash. So you call them up and they're like, what invoice? We never got an invoice. Send it to us right away. And then you send it to them and then back in the 30-day cycle or the 15-day cycle. So you want to make sure you're very preemptive when you're doing your invoicing. Make sure you do it timely. Make sure you're consistent with it. Make sure that you've got your rules set up, that you got an automatic email flowing out. If it's 5 days late, 15 days late, you get another email going out, maybe a phone call at that point, but just continuously. And keep in mind that don't look at it as potentially losing an engagement. This is a client that, they owe you money and you're not a bank. You shouldn't be put in that banking situation. So treat it without emotion, but as more of a matter of fact thing. And, if you have to separate yourself and have your accounting person take care of the bill for you or send it out there, however you want to do it, just make sure that it's very consistent on how it's being done. And you'll find that the money will come in more and more, I guess quicker on a regular basis there.
Yeah, I want to emphasize that real quick. I think the process is more, setting up a process is more important than the actual process, in my opinion. Like I've seen clients that are very successful with charging fees. I've seen clients that are very successful with stopping work. I've seen clients that are very successful with calling 3 times before they're paid. I've seen clients that are very successful with just calling once. But the thing is creating a process and following it 100% of the time. The worst thing you can do is not enforce anything or not follow your process until you need to because you're low on cash. That's the biggest mistake you can make, is only enforce it when you need it, because people are going to be like, oh, I've been late for 9 months in a row. Why are you calling me now? I don't care. You're not going to do anything about it. So the big thing is really making sure that you have that process documented and making sure it's followed from day one, and then it will be really helpful there.
Yeah, for sure. And you don't want to get in the position where you're calling them out of desperation, because that's the worst thing possible, right? So desperation tells them that, hey, maybe you're not a solid company as we thought you were. You can't handle X amount of dollars, that you don't want to be put into that position. You might not be, it may be a short-term blip, but it's going to come across as, wow, this company is really desperate. Maybe we should find another client because they may not be able to finish our job. People think the weirdest things when drawn to, this type of a situation. So make sure that you have this under wraps. I mean, that's the key. Be consistent. If they know you're consistent, then it's no issues at all. This is just how we do it here at Summit. We call every, after 5 days, we do this, do this. And so that they know, because that first email may be like, oh, wow, we forgot to submit. We didn't get this signed by, such and such, let's push it along. Let's get it signed. It just helps the whole process out tremendously. Don't feel like you're nagging anybody because you're not. Keep in mind they owe you money. Not the other way around.
Yeah, definitely. So on the expense side, one quick tip I have is, I had actually a senior accountant came up with this, and I heard her talk about it in a cash flow and thought it was great. But, again, we talk about predictability on the revenue side. We talk about basically recurring revenue and having the predictability there. But one thing you can do, if you have a lot of expenses and you're looking at your cash flow spreadsheet that you created and there's numbers all over the thing and they're every day and they're really hard to manage, you could use a credit card to straighten out those payments. So again, we don't want you to hold debt in your credit card. We're not a huge company that advocates debt, but if you pay off your credit card every month, it'll add some predictability to your expenses. And that it's due on the 15th, it's due on the 31st or whatever date that is. And it makes it a little bit more predictable. So, okay, I have payroll on the 15th, I have payroll on the 31st, I have my credit card payment on the 20th. That's 95% of my costs going out. It's very easy to sit back and look at that cash flow spreadsheet versus one that has numbers all over the place because you're paying things all the different times. So that's definitely one tip for expenses.
Completely agree. And make sure that you pay it off every single month. Jamie's saying, it's real easy to get in a position where it's like, oh, I'll let this slide and pay a minimum amount. And it's like, that's giving you really a false sense of where you're at truly in your cash position. So be really diligent. If you go that route, great idea, but make sure that you're very diligent in paying it off, on a monthly basis. And the same thing, you might rack up a lot of frequent flyer miles. Maybe you can go to the Cayman Islands for your new condo down there. So it shouldn't be a big deal. So with that, definitely agree with that. Great tip. I'd say the other tip would be, don't set, again, this is a true cash position. So don't get boggled into how much interest do I have on this loan when I'm paying it off or something like that. You're always looking at, hey, if the loan payment is $3,000, put $3,000. Don't break it out. Don't make it more complex than what it really is. Just put, whole dollar amounts just so it's in your cash flow position so you know where it's at. So I'd say don't get bogged down by the accounting side of things.
Yeah, definitely. And it sounds like Jody might be planning a trip to the Caymans here soon. Is that
Gosh,
what
I'm hoping.
All right. So we're getting a little close on time, Jody. Any other tips or anything else we missed on cash flow that you want to make sure the audience knows?
Like I said, this is the first thing we introduced to our clients way back when, and it's one that will never go away. So I would definitely recommend, if you're not doing it, go ahead and set it up. You don't have to buy a fancy software to do it. You can if you want, which is great, but you can do this on Excel or Google Sheets or whatever. Just at the very top, you're going to have a running total of your cash position. So every single day we'll have a balance from, basically the inflows, the outflows, and it just recurs. So inflows, out, beginning cash, inflows, outflows, ending cash, next column, beginning cash, inflows, outflows, and so forth. And just make sure you monitor that and keep that as close to vest. And the key, again, like we said, is looking at it on a regular weekly basis. Always having your bank balance in there. Again, that's your register balance, not your bank balance, but make sure your bank is reconciled when you're doing it so that you're not missing something that hit your bank that you weren't expecting. and then just kind of just forecast it out. It should be the one thing you look at every single week is what your cash position is, and if you're doing it more frequently, hats off to you. That's great. If you're doing it less frequently, then, you're really taking a risk that you probably shouldn't be taking.
Yeah. And then again, I talked about this a little bit earlier, but the other key is the conversations it creates on both sides, both the collectibles and the payables. It helps you understand what steps you can take. And the more timely you do it, the easier those steps are going to be. So I think that's the other key is, again, doing it a lot, but then also making sure that it's generating the right conversations and it's helping you run your business, because you'd be surprised, how the kind of conversations it will create and how it will make your business run much more effectively. So awesome. So that's all the time we have for today. I want to thank again Jody for joining the podcast, and we'll be back again soon with another great topic.
Yeah, thanks, Jamie.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving virtual CPA success. We're here to be a resource in this ever-changing industry.